Investors Chronicle.
Welcome to the Companies and Markets Show. We are recording this week on Thursday, the 2nd of May. That is an election day for much of England and Wales, of course, perhaps not for the last time this year. And to mark the occasion, we are going to be discussing one policy proposal outlined by Labour last week. Its plan to fully renationalise the passenger rail network within its first term if it wins the general election. Chris Akers will be here to talk about the impact on listed companies like Trainline and FirstGroup later on in the show. As well as that, UK indices have had a better time of it over the past couple of months, but we aren't confining ourselves to domestic shares today. Our cover feature this week looks at the world's biggest companies and what investors can learn from them. Mike Fahy is on hand to discuss. To begin with, though, we are going to talk about consumer staples because there's been a raft of first quarter figures over the past couple of weeks from the likes of Unilever, Reckitt and Haleon. And there are some suggestions in the data that some products aren't quite as staple-like as they were in the past. Jennifer Johnson is here to talk us through those results. These updates, of course, come in the context of continued rises in the prices of consumer goods, which everyone listening to this will be well aware of. Grocery price inflation is on the way down, but it's still in positive territory, sad to say, and prices of things like commodities like coffee have really soared this year. More on that later on. But seeing as it is an election day, and we are doing a podcast here, quasi-radio show, why don't we go with a classic poser for politicians? I'm going to ask you all the commodity, the food item that has increased in price most over the past year in the ONS food basket is olive oil. How much do we think a 500 milliliter to 1 litre bottle of olive oil now costs, according to the ONS? Any takers? Give me a number.
£6.
£6.
I'm going slightly higher. I'm based on obviously we're buying the Berrio,
The good stuff.
Yeah.
Yeah.
I'm going £8.
£8. Chris, your thoughts?
I was looking closely at olive oil in the supermarket last night, and I'm trying to remember, but I think I'll go for about £6.50.
Okay, well, Mike, you're almost bang on because £8, 4p now, incredibly, is what a bottle of olive oil costs. Climate change is responsible for some of that, of course, but there's been a lot of attention on the food producers and the supermarkets as well over the past few years in this context. Let's talk about the staples then, Jen. Not all of them focus on food, and not all of them focus on food at all, but Unilever, Reckitt, Haleon, we've seen the figures over the past few days. What do they look like? What are they telling us?
So I think at first glance, Unilever and Reckitt's updates might kind of indicate that consumers are regaining an appetite for brand name goods, given inflation is on a downward trajectory, and both of those companies exceeded consensus sales expectations in the first quarter. Haleon is a bit of a different story, but come on to that in a minute. Beneath the top-line growth at Reckitt and Unilever, I think there are some clear operational difficulties, some of which are structural and have been evident for a while. Others, like the litigation around Reckitt's infant formula, are a bit more recent. Haleon was the only one of the trio that we're discussing here that saw reported revenue decline year on year in the first quarter. Sales were down 2.2% and volumes were down by a similar percentage. Part of this is because the company did particularly well in the first quarter of 2023, so the comparisons are a little bit tough. But I think if we were to identify a common theme in all of these updates, it's that they're hit or miss. There's no definitive recovery in motion as yet, though excitement around Unilever and Reckitt's share prices last week might have led you to think otherwise.
Yeah, that excitement was perhaps due to the bit of the surprise was that the volume growth was better than expected. I mean, given my big build-up as well, it is surprising that perhaps the volumes are improving, albeit the context is food price and consumer good price inflation is falling in a lot of cases. So there is the potential for them to make up some ground there because the issue has been, hasn't it, that revenue's been rising because they've been putting through these big price increases, margins not so much because costs have been going up. But that's been putting pressure on volumes because not as many people can afford to pay those higher prices. These figures, though, as you say, for Unilever and Reckitt looked a bit better. Let's look at Unilever in particular because we've spoken about it various times and written about it a lot. It's a popular share, of course, and it's got a new chief exec. It's got a new plan to reinvigorate the business, part of which involves separating the ice cream business. How's that been received by investors and analysts? The suggestion is it's going to be either spun off or sold, something like that, within the next year or two. Does this seem like a good decision? What does it imply about the business in future as well?
So when the plan was announced in March, the shares rallied and Unilever is now up by something like 9% in the year to date. So there's clearly some positive feeling, positive momentum behind the company. It seems investors are generally happy that management is taking corrective action to revive the business, which has been an inconsistent performer, if we want to put it charitably. Nutrition, the Unilever's nutrition division, which is things like Marmite, your supermarket staples, may seem like the logical next division to go because it has consistently underperformed analyst expectations. Underlying revenue grew 4% in the first quarter, but volumes were down. So it's clear all isn't well here. Whether investors actually push for management to offload this arm of the business probably depends on what ultimately happens with the ice cream spin-off. I think an important trend to note here across all three companies actually is this intensified focus on what they call their power brands. Those are things like Sensodyne toothpaste at Haleon or Dettol at Reckitt. They're invariably huge sales drivers, and the companies have all indicated that they want to focus on continuing to build these brands and expand market share. So I think if you read into that a little bit further, that's a clear indication that the companies want to rationalise their businesses. Investors seem to have soured on the large consumer conglomerate structure, so they're less tolerant of the underperforming divisions. And I think with the ice cream spin-off at Unilever, this could really set activist investors in motion at similar companies, try and get rid of these divisions, which are a bit of a drag really on the top and the bottom line.
On that note, let's turn to Reckitt. Now, there's the overhang, is a polite way of putting it, of the litigation risk, which really shocked investors a few months ago. But there is also talk there, maybe slightly idle chatter, but talk there about how the business could look in future at Reckitt as well, whether they might also want or could do with spinning off some parts of it.
Yes, it's Reckitt's nutrition business, which is different than Unilever's. Reckitt's nutrition business does things like infant formula. And just as a kind of bit of background on what went on there, the shares dropped 15% in a single day in March after a jury in the US awarded a woman $60 million in damages, saying that the company's Enfamil baby formula led to the death of her premature baby. The company is now vowing to fight back against the verdict, but I don't think you have to be any kind of an expert in consumer staples to see that US litigation of this nature is generally really bad news for shareholders. If you look at something like the Zantac litigation at GSK, which is the heartburn drug that tens of thousands of people have claimed caused them to develop cancer, that's been a huge drag on the shares for years and continues, I think, to really kind of put a damper on them. And Bayer has been completely hobbled by the legal action around its glyphosate weed killer. And there's really no good estimate at the moment, or any kind of reliable estimate at the moment, for Reckitt's liabilities in this baby formula case. Analysts say anything between kind of nothing and 8 billion. So whether you think the company is investable at this point is kind of a question of whether you think its portfolio is strong enough to beat guidance and lift the shares in spite of the legal action. And I'm sure there are investors who think now that it's absolutely necessary to get shot of the nutrition business, which is kind of considered one of the worst corporate blunders in recent memory. Reckitt bought this company, Mead Johnson Nutrition, for 18 billion in 2017, and a couple of years later management was forced to write down 5 billion on the carrying value. So this has become a real thorn in the side of Reckitt, and what, if anything, the company chooses to do, I think will be very closely watched. But there's the bottom line, I think, with US litigation of this sort is that it's extremely difficult for the market to get its head around. It can become extremely complicated, extremely expensive. Even best case scenarios are still really quite expensive. So litigation is a material risk, and I think you have to be very, very, very confident in the company beyond that to invest at this stage.
The baby formula arm was previously a pretty good asset for Reckitt, not least because of some competitors in the US had problems with shortages or with their own products being suspended from sale. But both that and the legal case does highlight that, of course, this is a very sensitive business they're in, and there is huge risk of things going wrong. But let's stay with the US, because there have been some other reports we've seen, as well as underlying data about the state of the US consumer. And it does feel a little strange, perhaps, to be talking about US consumer weakness, because we've all been brought up to learn that you should never bet against the US consumer. But the figures there as well are a little bit concerning from a company point of view, maybe even, well, certainly economically and on a personal level for some people too, because you've seen Procter & Gamble, obviously a big peer of Unilever. They posted the lowest organic sales growth for over 4 years in the first quarter. There's also been indications from the companies like McDonald's and Coke and Pepsi that, this growth story is struggling in the face of price rises that they've had to put through. Obviously, a lot of lower income consumers buy those products, and maybe we're finally getting to a stage where those price rises are proving too great.
Yeah, I think this is obviously all of this has to do with the real kind of sticky inflation in the US. So we may see the fortunes of companies kind of diverge if Europe continues on a lower inflation trajectory. But really in the US, you've got this very evident bifurcation that the companies are all kind of calling out themselves now, between low-income consumers who are increasingly not going out to eat, even at places like McDonald's and Burger King, and you have the wealthier consumers who haven't changed their patterns of consumption particularly at all. So that is something clearly that these kind of mass market food companies are particularly aware of, and it's something that we'll have to see how it plays out. There's no real indication that US inflation is going to fall off a cliff anytime soon. So that's potentially consequential for any company selling to a consumer in the US, whether that's a pharmaceutical company or, a Haleon or a McDonald's.
The other area this touches on is coffee, which is coincidentally the subject of another feature in the IC this week. Starbucks this week saw shares really fall quite significantly, about 15% at one point, I think, following its figures for the first quarter, which are very much in keeping with Nestlé's figures in terms of its own coffee arm and some other companies as well. We've seen coffee prices rise really quickly this year, but it does seem almost before that happened that coffee is one area where consumers are pulling back. Now, I do not drink coffee, so this is all new to me, but I am vaguely aware of the fact that one can get some pretty expensive cups of coffee nowadays. And once again, there are signs that that's just becoming too much for people in its various forms.
Yeah, and I think there's only so much down trading you can do in coffee, right? And some of these commodity price rises are going to be passed along to the consumer. So at a certain point, it might just seem logical for people to stop drinking coffee altogether. That's unthinkable for me, but then every time I do have to pay £4 for a flat white here at our preferred coffee shop near the office, it's physically painful.
See, that was a question that you should have put to us in terms of knowing the price of an item, because Jen was right on that there.
£4, yeah. Well, there were some stories this week, weren't there, about a £5 cup of coffee, which again, I'm totally oblivious of. I couldn't tell you how much it cost 2 years ago or now. I recommend tap water. It's a very boring, very cheap lifestyle. Anyway, that's all we've got on consumer staples. It's probably time to move on. You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. Talking about train companies, Chris, you covered this for us in the news section this week on the back of Labour's proposals last week. Can we talk first of all about what exactly they've suggested and whether anything in those proposals came as much of a surprise or should have come as a surprise?
So Labour wants to create a new public body called Great British Railways, or GBR, which it said in its announcement last week would be responsible for the day-to-day operational delivery of the railways. So what that means is contracts held by private operators would be nationalised when they expire, or the contracts could be broken because of underperformance. Labour has made clear, though, that rolling stock companies, which are companies that lease out trains to private operators, would not be nationalised under the plans. The policy was actually announced at Trainline's headquarters, interestingly, and maybe that's a way of emphasising that Labour still wants some private sector involvement in running the railways to continue. There weren't any major policy surprises, I would say, but it can maybe be seen as reassuring for private operators. The Labour did make some positive comments on the rolling stock companies and on the independent open access companies, which have sort of introduced competition into UK rail.
Yeah, we'll come to that open access arm in a minute, but it was interesting. They held it at Trainline headquarters, clearly an attempt not to scare the horses. But I think there hadn't been much talk about it for a while, and there had been watering down of other policies, so maybe people thought this was one that might not make it through. And judging by the share price reaction, there was some surprise that certainly for Trainline investors, because there was a fairly notable reaction to the announcement, it's fair to say.
Yeah, so both Trainline and FirstGroup shares were hit on the back of the announcement. As you say, Trainline a lot more heavily. So Trainline shares are down by about 13% since the announcement. FirstGroup down by only about 2%, a lot more muted. It's not really surprising with Trainline, because when GBR was first proposed by the current government back in 2021, the Trainline shares plummeted. It's important to note Labour doesn't seem to be reviving a plan to centralise the ticketing system, although it says its proposal does involve replacing the current multitude of platforms and a myriad array of fares, discounts, and ticket types. So that's something to watch moving forward. An analyst I quote in the piece does argue that sort of Labour's approach to ticketing helped remove uncertainty hanging over Trainline with GBR, so that's something to think about as well. And Labour's hopes of rolling out digital season tickets and automated delay repayment across the rail network sort of plays into Trainline's digital business model quite well, I would argue. So could be opportunities as well as obvious risks.
Yeah, Trainline, of course, the vast majority of its money does come from the ticketing app and website. And prior to this, I mean, its shares have been on a bit of a roller coaster this year, haven't they? Because its trading update a month or so before Labour's announcement was very well received. It's got full year figures, we should say, out tomorrow, i.e. by the time this podcast is released. But the trading update had most of those figures in, and they looked pretty good in terms of the underlying business.
Yeah. Trading been very encouraging for investors. So just for background, Trainline has three divisions. It's got its UK consumer and international consumer units, which sell train and bus tickets. It's also got a Trainline Solutions arm, which provides booking services for companies and some other things. So yeah, the company said in March that all three units posted some pretty chunky double-digit revenue growth in the latest year. It's benefiting from the trend towards digital tickets and also market liberalization in Europe. Revenue growth, it said, came in at 21% ahead of its guidance, and adjusted cash profits also came in ahead of guidance. We'll find out more tomorrow, as you say, and maybe get some comments on current trading and potentially some narrative around the Labour proposals as well.
Let's turn to FirstGroup, because they are in some ways more directly affected, or they will be when train operating companies' contracts end and they are then nationalised under the Labour plan. The plus side for them on two levels is one, these contracts have still got a fair few years to run and they're not going to be brought forward. The other being this open access business that you mentioned at the top. Can you say a little bit more about what that is and why there might be a string to the bow, especially if these plans go ahead, perhaps?
Yeah, so on the face of it, the plans are obviously a big risk for FirstGroup. It's actually publicly describes Labour's approach as a risk before, so it's clearly a threat from these proposals. It takes most of its operating and cash profits from three businesses: Avanti West Coast, Great Western Railway, and South Western Railway. And as you say, these face being taken into public ownership when government contracts end over the next couple of years. But it's also got what it calls open access companies, and these are limo and Hull trains. And they've actually been performing pretty well, better than expected, the company says. They've been contributing relatively more profit to the business over the last couple of years as the proportion from government contracts has actually fallen. It's important to note the open access companies won't be impacted by Labour proposals, and FirstGroup is exploring new growth opportunities in this space. The analysts I've spoken to for the piece think that sort of the nationalisation plans have actually been priced into the FirstGroup valuation and outlook so far. And it's also worth bearing in mind that FirstGroup, of course, also operate buses, so it's not purely a train business.
Yeah, that open access growth has been quite notable. It's still, I think, the profitability is still about a quarter of the rest of the business, but it's certainly growing quickly, and there's potential there, as you say, for expansion. What about the valuation of both these businesses? How do they look right now with this potential threat, or in some cases, as analysts are trying to argue, the threat has been cleared up because now we know what the likely next government's going to do? I mean, that still seems like a bit of a leap, but how do you see the valuation case for both of these businesses?
Yeah, so it's the Trainline, fair to say, has a relatively rich valuation. The shares are trading at about 19 times enterprise value against cash profits, and that's in line with the 5-year average, so no discount there. Still a buy on the company ahead of the results tomorrow. I think it's an attractive long-term stock. As I mentioned earlier, taking advantage of market liberalisation in Europe, doing very well in the domestic market still. And I think the market reaction to the Labour policy announcement does look overdone for Trainline. FirstGroup shares are trading just under their 5-year average at about 10 times forward consensus earnings compared to a historic position of 12 times. We're holds on the business. I think the valuation is fair, and as I mentioned, policy seems to be priced into the outlook as things stand.
Yeah, that seems like a fair assessment. And we haven't mentioned the other main listed transport stock, which is Mobico, former National Express, which has plenty of problems of its own, unrelated to rail nationalisation. But we'll save those for another day. Our cover story this week, though, is on national champions, the world's biggest companies, whatever you want to term them. Mike, you wrote this piece around the world tour in many ways. Can you talk a bit about the thinking and also how you ranked the companies? I mean, there's one obvious answer, but there's various metrics you've included in the piece as well.
Yeah, sure. So we have in the IC for quite a few years run articles where we've looked at the world and the investment possibilities through the prism of investment trusts, and that has been quite useful because it shows you what's going on in a particular market as a whole, but also we then dig into the differences between the trusts and how they perform. I've thought about replicating that and looking at countries through a single share and what that might tell us, if anything, about those particular countries, and then just started to maybe screen it down a little. When you look at the entire kind of world of capital markets, there are reasons why a lot are excluded, and it's, if we're telling stories about countries and equities, in many places it's quite dull. It's your biggest equity is either quite often a bank or a natural resources company if you're in somewhere with huge resources such as copper, etc., or it's a telco. So I try to focus on countries with interesting companies. There is one natural resources company there in Saudi Aramco, which has, there's a lot you could say about it. It's a fascinating company in many ways, and the fourth largest in the world. So when we come to rank the companies in the feature, we rank them by market cap. If you're looking at the biggest companies, then it seems a logical way of doing that. But we did sort of look at some of the other factors involved, because especially when you're looking at emerging markets, there are plenty of other risk factors to consider. There's, in some markets, as Alex Hamer mentioned in his India feature, direct access can be quite difficult, if not impossible, for a foreign investor. In other markets, there are capital controls, so even if the investment looks really good, if you can't repatriate your money back home again, then there's little or no point in investing. And in others, you've got to consider things like currency swings. One of the companies in the feature is Dangote Cement, which is Nigeria's biggest listed company, and the fall of the naira there kind of really puts into stark contrast the dangers of investing in somewhere either with hyperinflation or massively falling currencies. So as good as a company may be, and Dangote Cement seems like a good company, the risk to your investment there can be huge based on currency fluctuations.
A lot of these companies, though, I mean, part of the reason the feature is worthwhile on another level is whatever the intricacies of individual investment nowadays, you can access them via single country ETFs.
Yep.
And even if you don't do that, even if you buy a fund that is an active fund, say in Japan or in emerging markets, you're going to have a decent amount of exposure to the biggest companies in those markets. Japan, for example, Toyota Motor is about 5% of the index, so it's the biggest, obviously the biggest holding in the topics. So if people are capitalizing on Japan's rally, they're going to be invested in Toyota Motor. Why don't we talk a bit about Toyota, how it's been doing, what it's looked like, because we discussed that in a piece as well.
Well, yeah, and I mentioned that it's had quite a lot of criticism in recent years, both from environmental campaigners who were displeased with the pace of its transition to EVs, or from US pension funds who are concerned about the independence of its board. And corporate governance, again, is another thing that we look at, and we rank countries on the minority shareholder rights. This, I think, is very relevant in Japan, and particularly now. Toyota's done really well. Its share price is up 90% in local currency terms over the last year. It's a bit less in US dollar terms. But there are two principal reasons for that. One is very much company focused, which is that Toyota has not, as I mentioned, it's not gone as quickly down the EV route as others. It stayed very firmly in hybrids. And as this EV adoption has slowed down, more people have looked at hybrids. Hybrids have become more in demand, and its sales have done well as a result of that. The other is that one of the reasons why it hasn't progressed EV adoption so quickly is because it's been working on solid-state batteries. It's not as convinced of the long-term benefits of lithium-ion, and it's had some breakthroughs there. I mean, that's still taking time, but it's feeding through, and both of those things have contributed to Toyota's growth over the last year. But the other is, as you've mentioned, the Japanese stock market itself. You know, the exchange has tried to become a lot more transparent. Things like cross holdings, which Toyota has some cross holdings, they're trying to eliminate it, and companies that trade at less than their book value are being asked to explain to the capital markets why that is, and what they're going to do about it, so that it's not something that's persistent.
Minority shareholder rights you mentioned there as well. Japan still scores quite lowly on that level, but I had to check this with you yesterday, didn't I, when we were going to press, because the US minority shareholder rights rank, they rank 36th. The next entry, Saudi Arabia, on minority shareholder rights ranks 3rd.
Yeah.
It was incredible to me.
Yeah.
Obviously, that's slightly different from the other listing we have there of the corruption index rank, but you know, it's worth noting perhaps at the same time.
Yeah, and so there are many reasons for this, and there's also one big caveat in that this is based off the World Bank's doing business rankings, which the World Bank itself suspended in 2021 because there was some data irregularities. They said there have been all sorts of investigations into this, and it seems there was undue influence into the rankings by a couple of countries, China being one, the UAE being another, in terms of trying to get their scores down or up, depending on which metric that you were looking at. But I can see why that is the case. I mean, as far as I'm aware, for instance, Saudi Arabia does have quite a few protections in terms of minority shareholders. It also, I don't think it has dual classes of shares. So when you are looking at things purely from a minority investor's point of view, and it's not something I would encourage because other factors outweigh, but when you're looking at it purely from a minority investor's point of view, the US can be a much less unfair market.
Much more unfair market.
Much more unfair market,
Yeah,
sorry.
yeah. Let's finish by talking about ASML, a company a lot of people will have heard of by now, certainly due to its rise to prominence in recent years. One of the biggest companies in Europe, the biggest company in the Netherlands, unsurprisingly. But clearly it's been riding the semiconductor/AI boom.
Yep.
But its figures recently were a little disappointing. Can we talk a bit about those and the outlook for the company as well?
Yeah, so in the first quarter, numbers came in, order numbers came in, and revenue numbers came in a little below expectations. And they also mentioned that in the second quarter, the outlook doesn't look so great in terms of orders right now. But I think it's important to point out that orders can be lumpy for a company like ASML. And I was reading an analyst note on this from HSBC quite recently, and even though they described the orders so far as disappointing, they still upped the target price on it and maintained a buy recommendation. And after speaking to management, I think became a little more reassured about the outlook for it, because they pointed out that the drop in the first quarter is quite unusual in terms of its scale, and that if you look at the last 2 years and just averaged out orders, then the recovery in the second half of this year, just by reverting to the mean, should mean that it outperforms where a lot of analysts think it will end up currently.
As I say, that is our cover feature this week. Have a look for it online, in print. There's a lot of other countries featured in there that we haven't had time to talk through because, unfortunately, we are at the end of the show. That is it for today. So thank you very much to Mike, to Chris, to Jen, and to our producer, Vic Thornton. We will see you next time on another Companies and Markets show.